If you can't get people to vote for you, just pay them to do it. Seems to work in the past. See if it works for you this time. My name's Eric. Welcome into Above My Pay Grade. Thanks for tuning in. If you would please smash the like button and share this with friends and family if you think this is useful and informative. And I will say, if this affects you, if you're somebody that has a pension, I'd love to hear what your thoughts are. But I have a couple articles. I will link to them in the description below. But Biden yesterday came out and revealed part of his pension protection plan that was attached to the 18,000-page American Rescue boondoggle. So under this pension protection plan, I'm going to read from the CNBC article that I'll link in the description. Under the final rule, the program, 2 to 3 million workers and retirees who faced pension cuts because of investment losses will get the benefits they were set to receive for their retirement, a White House official said. Now, in the most basic terms, what this is the government coming in and saying, hey, you know how you invested in your 401k and it was right before an economic crash? Or let's say you lost money on an investment. This is the government coming in and paying you money for your investment losses. That's what this is. They can couch it in any way they want, but this is government coming into private individuals, private investment firms, and if they can't make their investment nut, which we'll talk about here in a second, if they can't make that their investments pay out their beneficiaries, then the government will make up the difference. Does this seem a fair market to you? Those of you who hate capitalism, does this seem capitalistic to you? Seems a little socialistic-y to me. And not to mention, this is just government spending on top of spending that's coming not from productivity, which, what have we learned? That is inflationary. That's right. So what happens with these pension funds and how do they work? So a brief kind of overview. These multi-employee or employer pension funds, let's say it's attached to a union, let's say the Iron Workers Union that Biden was addressing here in Ohio. Let's say it's the Iron Workers Union. They all pay into this pension fund that's managed privately, and this pension fund has to make a return. So this big chunk of money goes into this pension fund, and the employees pay into it. The union workers pay into it. So they are entitled to it, but they need to understand this isn't risk-free. The markets are not risk-free. So to assume that if you pay into a pension, therefore you're guaranteed to get the money back and you get paid for the rest of your life, guaranteed now by the government, that's a little bit of a stretch. But they pay into this pension, and these pension funds have massive, massive amounts of money. One of the pension funds says we were on pace to become insolvent in the near term because their investments struggled during the economic crisis, much like everyone else's. Okay, so when a pension fund struggles, that is when the government swoops in and starts paying people. Very interesting. So why aren't these pension funds making enough money to pay out their beneficiaries? Because typically how they work, the people pay into it, and as that money earns interest off of investments, they pay people as they retire. Yeah, pretty solid business plan, right? But the best business plans are the one that have government backing, right? If it fails, the government and the Fed will just bail you out. Genius. Okay? So I'm going to link to this other article that talks about how pension funds work, but they used to basically only invest in blue chip stocks, Fortune 500 companies, and treasuries. That's pretty much all they invested in. Now, if you've been watching this channel for any length of time, you know that treasuries are hot garbage, right? They aren't beating inflation. And so when a pension fund invests money into a treasury, now they're not only they're not making money, they're losing money on that treasury. So that means the other money that they have has to make an even better return for them to make enough return to pay out the beneficiaries, if that makes sense. So it says why they changed from just treasuries and Fortune 500 companies is changing market conditions, the need to maintain high enough rate of return that resulted in pension plan rules that allow investments in the most asset classes. So now they're spread out into different asset classes, but they still have treasuries, which is hilarious because the government is coming in and helping them out because of the government treasuries sucking so bad, right? Their risk-free rate of return, which is a lot. A pension fund doesn't want to take a huge risk. Why? Because they have to protect the capital, and they just need a smallish rate of return. And I'll read here. U.S. Treasuries and securities, security grade bonds are still a key part of pension fund portfolios. So every single pension fund that has bonds in them and that are buying them now are losing money, right? If they kept it in cash, they would lose more, of course. But if they buy a bond, they're losing money, which means the other investments have to make up that difference. As an example of the prevalence of fixed income securities in pension portfolios, the largest pension fund in the U.S., California Public Employees Retirement System, so that's pretty much all public employees in California, it's called CalPERS, seeks an annual return of 7%, with approximately 1/3 of its $385 billion portfolio being allocated to fixed income investments in March of 2020. So you see what I'm saying here? CalPERS, in order to pay out their employees, once they reach a certain age, they can start drawing from their pension, right? Once they hit that age, CalPERS has to make 7% in order to this algorithm to work, to keep paying out those people without drawing down on principal. CalPERS, a third of their money is tied up in bonds and treasuries. And that money is losing value because the bonds aren't beating inflation. So the other stuff they're invested in, whether that be real estate, whether that be equities, has to make up that difference. And it's not, because the market is hot garbage. So what does the government do when this stuff happens? Print more money and give it to these private pension funds. It's insane. It's absolutely insane. It really is no different than you investing money in your Roth IRA and taking risks, because the market has risks. And when it's retirement time, you go, oh no, I don't have enough money. And the government comes in and says, we'll make you whole. There's no difference here. I guess the only difference is this is a huge voter base. So unions, there's the difference. So here's the bottom line. It says here at the bottom of this article, pension funds make promises to their participants, guaranteeing them a certain level of retirement income in the future. So a lot of these people who bank on this retirement aren't prepared for anything else, no contingencies. It's this pension or bust. So when this pension can't make this their 7% like CalPERS, then they can't pay out their beneficiaries, right? This means that they have to be relatively conservative, and that means government treasuries in terms of risk, but also they have to have sufficient returns to cover those guarantees. So they have a conundrum here. They're between a rock and a hard place. The last 40 years, bonds and treasuries have been a great investment. Today, they are not. So where do they put their money? Because they're losing money every single day if they decide to buy treasuries. And they have to make this calculated risk. Is inflation going to go higher? Do I buy a treasury, a 30-year treasury, a 10-year treasury, and get a 3% rate of return expecting inflation to drop, right? Because then that money's tied up. It's catch-22. But I'll tell you this. The answer is not government coming in and printing more money and giving it to these private, I'll say that again, private organizations. Let me know what you guys think in the comments. This feels like it's got to be illegal somehow. Maybe not, I guess. It literally seems like they're paying for votes. But I guess they do that in other ways too. But It seems ridiculous. And I guess the people that benefit from this don't understand that this money's coming out of thin air, therefore it's inflationary. So that guaranteed pension you were getting, it now has less purchasing power because the government chose to print money to make you whole. Let me know what you guys think in the comments. Thanks for watching. Thanks for listening. See you guys in the next one. Peace.